Welcome to today's webinar. Thank you for joining us. My name is Alex Wilson, President and CEO of PreciousTimber.com. Today we're going to be talking about a very important message, a very timely message too, I believe. And so maybe you want to grab a pen and a notepad and take some notes. On the screen is our confidentiality notice. This message does not constitute any research report or recommendations, and it's not an offer to sell or an offer to solicit any security or interest in any fund or anything like that. But the message today will probably resonate with everyone on the call. Unfortunately, the space that we're in really is only occupied by about 3% of investors. So in other words, most likely 3% of the audience that hears this message will take action. 97% will find it interesting, find it intriguing, will probably not take action and continue the status quo. I hope you're one of the 3%. The message is, why alternative agriculture now? And why is it a critical time in our investment history here to take a look at agriculture with what's going on globally and, more importantly, here at home? Well, of course, we all are very familiar with some of the pressures, the many pressures that is causing our economy here at home in the US and across the world, quite frankly, to be, let's just put it like this, not in a very healthy state. The US has an unfathomable amount of unfunded liabilities. We're facing, looking down the barrel of a large credit default crisis. And the question is, what will be the next trigger? Of course, in 2008, the trigger was the Fannie Mae and Freddie Mac debacle that started with the stock market and then ended up sinking pretty much every single boat, including real estate. And so when those triggers come, really, where does an investor go? What does an investor have? Where can they find shelter when stocks are falling, real estate is falling, everything around them is falling in value? Of course, there's a lot written about this, whether you're a fan of any of these two authors and individuals, Doug Casey, a great book called Totally Incorrect, and Jim Rickards' Currency Wars, The Making of the Next Global Crisis. And there's multiples and multiples of things that we can read. Of course, some of them we have to take with a pinch of salt. A lot of these people are doom and gloomers, but you can't avoid, and you certainly can't put your head in the sand when it comes to the pressures on global markets today. So I think the question isn't if the economy will crash again, and whether if we're going to have another major financial crisis. I think the question really is, when will it be? And my message today is, do you have a portfolio that's balanced correctly? One in which will not only weather the storm, but can cause your net worth to increase while everything else is going down. If you're part of a family, you have a family, you're inside of a family, and you're concerned about family wealth, generational wealth. Most of my clients are generational thinkers. They're not short-term profit speculators. They are individuals that understand the way to create wealth is find value in what it is that you're investing in. In other words, a value investment proposition, and then hold that asset class for a very long period of time. It's one aspect of the investment community that I think few people follow. I'm going to be referring briefly to two fabulous and very educational books, Family Fortunes by Bill and Will Bonner, How to Build Family Wealth and Hold On to It for 100 Years, and also one that I've read now 3 times and recommended it here for the past couple of 3 years, The Alternative Answer, the Non-Traditional Investments that Drive the World's Best Performing Portfolios. And it's a book that I think every investor should read. because there are certain investments that will drive your portfolio to being one of the best producing portfolios, and there's certain things that you have to avoid, and the things that you have to avoid are the things that you've most probably been doing for the past 20, 30, 40 years. The focus on making sure your family stays wealthy if you have money, and the focus on creating income if you are still trying to create that fortune, and how to make sure that it lasts way beyond your lifestyle, way beyond your life expectancy if you have a family. In other words, we're talking about legacy investing, where if you take the approach and focus on legacy investing and look out 50, 100, 200 years, and make sure that your family is on board, make sure that the money that you have will be around for that long, well, then you don't really have to think about your retirement and whether you're going to be able to afford it, because you've already placed your investments in asset classes that are not going to go to zero, and they're going to spin off multiple streams of cash flow, giving you plenty of income. And so whereas most people are thinking about, I have to save for my retirement, generational thinkers don't even think about their retirement, because they know their retirement's going to be safe, because they have asset classes that don't go up and down. They have asset classes that continually grow. They have asset classes that are going to be there in the next crash and the one 100 years from now. So we'll move into that, shall we? And I'm talking about portfolios that are held by, they can be large families, very, very wealthy families. They can be held by institutions, and they can be held by endowments. In the Alternative Answer, the book basically starts out by talking about Yale University, where it only has a 6% allocation to the stock market. Talks about Harvard University, that has fully 10%, maybe a little bit more than 10% of their portfolio in foreign, international timberland. And so these are things that these portfolios have added to their asset allocation model, and they've done so that they can avoid those gut-wrenching, volatile times in the marketplace. These portfolios love real, tangible assets. They don't particularly like paper assets. They like assets that generate consistent cash flow and gain constant capital value appreciation. Most of the individuals that run these portfolios and own these portfolios manage their money themselves. They do not use financial advisors. Most financial advisors probably would think this is kind of an alien approach. Well, it is, and it's deliberate, so that you don't get feed to death. The financial advisor and financial planner oftentimes makes their living on the fees that they charge. And I've never personally had a financial advisor that has been able to amass a fortune for themselves, but it's funny how they can manage other people's money. Not saying that financial advisors are bad, I'm just saying my personal experience. There are three main differences, three very big differences, that those that have wealth have created wealth, and those that successfully pass it on generation after generation after generation and don't lose the money by passing it on to the second generation, and then there's nothing left for the third generation. The first thing that they follow is this creed, this family creed, the culture. It's a set of beliefs, a set of aims, if you will, that guide the family's actions in the things that they do. The second thing is they focus on loss avoidance. You may have heard another presentation of mine where we've covered some of these points, but the investment focus is on never losing, embracing the long-term wealth creation attributes of certain asset classes over short-term profit speculation. Most people are betting when they put their money in the stock market or in an IPO. Most people are betting when they take on things like gold that it's going to go up. Listen, gold's a great place, and we'll talk about that, but it's really not a very good place to invest. It's a good place for other reasons. And then the third thing that these families, these investors that hold on to their fortunes for generation, they build hard and soft structures. We're not going to go into that one today. We went into that on another presentation. But let's quickly look at the family creed and the family culture. It's a set of beliefs, as I said, that guide the family actions, and most families just let things happen the way they let things happen. But wealthy families sit down with their families, especially serious old money, and they write a family council and put a certain aspects of direction in place. They don't spend their money on frivolous things, and they don't care about looking or impressing people from an image point of view. They prefer to have teamwork. Teamwork's the key, and of course it takes, more than one person to have teamwork. It takes at least two to tango, and it starts with the patriarch and the matriarch working together, both in their own individual roles, to ensure that the family is following the same family creed, the family belief system, so that everyone within the family can be on board with regard to the finances. The real wealth in ultra families is not the money. It's actually the family members. It's important to get a good education. It's important to notice and foster and enhance and follow your talents. It's very important to place the family members in the right place, those that have knowledge and those that have experience. I mean, you can't just take a position in these large families and start using the money for your own gain. With no knowledge and no experience, no talent, and certainly no education. Of course, it's a burden on people that grow up in families that have a lot of money, but they don't have any direction on how to increase the family money and how to take care of it. They end up just wasting it, spending it, and sometimes it spirals their lifestyles into a negative direction. We mentioned this loss avoidance. Loss avoidance is simply this: you place your money into asset classes, the large majority of your money, into asset classes that do not go to zero, and even some instances where even when things go bad, they're actually increasing in value. Very unlike the average investor. The average investor makes three critical mistakes. They think that the 60-40 asset allocation in their portfolio is the way to go. Absolutely is not, according to the super wealthy and the generational investor. They think that stock diversification, the average investor thinks stock diversification is safety. Ooh, I've got 60% of my portfolio in the stock market, but I've got 52 different companies across 32 different sectors. Well, that showed you how good that was in 2008, wasn't it, when everything went down? They also think buy and hold is always a winning strategy. You'll always win in the long run. In fact, that's not the case. The stock market, 7 out of the 11 decades since 1900 have produced dismal, anemic returns of less than 1%. So, of course, if you're emotional like we all are, and we buy and sell at the wrong time, that causes the portfolio to really, just sputter along. Stock diversification, I'm diversified over growth and blend and value and small and medium and large caps, and so 3 by 3 here's 9. I've got 9 different buckets, but we all know that didn't work for anyone in the last crash, and certainly Harvard Endowment got hurt by losing $10 billion that way. So they moved out. They've done a little thing different, and they've moved a large percentage of their portfolio into timberland, not only in New Zealand but Romania and other parts of the world, Latin America. They want safety. They want safety, and they know the importance of holding onto money and not speculating to grow it. It's more important to keep it. Buy and hold. That's great as well, so some people say. But of course, if you're buying and holding and your time frame for you to need it when it comes to paying for college educations or helping kids start their life out, or even when you yourself need to start pulling income out, these buy and hold strategies and scenarios, they haven't worked that well, and quite frankly, it's not what the super wealthy look at. I mean, if you get a 50% loss, it requires a 100% gain to come back from that. What they like is portfolios that include what I call shock absorber assets. Shock absorber assets are assets that minimize the losses when the markets are going in the wrong direction, and even profit in periods of great turmoil. So in other words, when things do start tanking, you have something that doesn't care. It's not affected, and in fact, sometimes they even increase in value. 4 main portfolios of four main jobs, I should say, of these super wealthy portfolios are quickly to produce higher inflation-protected income. Must have a strong base. Look how I've underlined strong base. A strong base for risk reduction, loss avoidance. They focus on long term. They hate liquidity. They hate having investments that are easy liquidable, and so you can get out at the flash of or the click of a mouse. Whereas the average investor, one of the first things they ask is, well, is it liquid? I'm not investing in anything that's not liquid. Well, of course you need something that's liquid if you're in things that are going up and down like a darn yo-yo or like a roller coaster. You need to be able to get out quick when the things are losing value. But if you're in asset classes that don't react that way, then you understand that the getting in and getting out, it's actually it's a negative. It's a deterrent. It's a cause of you not earning the returns that you'd hope for. And then the fourth thing that a portfolio's job is to purchase, I should say, protect the purchasing power of the portfolio. But let's go on and talk about this liquidity point that I just made. There are semi-liquid assets, things that you can get out of pretty quickly and pretty, instantly. And then there's illiquid assets, things that can't be sold instantly, but usually you can get out of them within a year or two. And then there's anti-liquid assets. What the super wealthy like is they like the last two. They like illiquid and they like anti-liquid. And an illiquid investment is something that relates to what we do. It's something that you can sell, but you can't sell it instantly with a click of a mouse, but you can sell it generally within a year or so if you had to, and that's timberland and coconuts. And so the question then is, what is the most favorite asset class of these endowments and these institutions and these high net worth individuals? Well, it's quite frankly dirt. It's one of their most favorite asset classes. You don't think the dirt in a forest or the dirt on a farm is affected by the stock market. If it's growing something, Mother Nature continues every single day, whether the stock market's up or the stock market is down. It doesn't matter whether there's a war going on in another part of the world or a political upheaval. If you've got the dirt and you're growing something in that dirt, and every year that commodity that you're growing gets consumed into the worldwide marketplace, you have an asset class that's continually spinning off cash flow, spinning off income, but the underlying asset class, the hardcore, real tangible asset, the dirt, continues to increase in value. As I mentioned, timberland. That happens to be one of the favorite of all hard assets of the super wealthy. The gentlemen on the screen, none of them made their money in timber, but all of them have billions of dollars, large percentages of their net worth in timber. The average person's, first of all, probably never considered owning timber, but they certainly hold none, virtually nothing, most people. Some may have a REIT, a timber REIT, or a timber publicly held company, but that's not the way the super wealthy hold it inside of shares or inside of a partnership. They own the dirt, they own the trees, and they have someone else manage it for them. And then when the commodity's sold, you're turning around returns on investment numbers that most people think are impossible to achieve. In fact, even billionaire money manager Jeremy Grantham said that timber is the only low-risk, high-return asset class he's ever found. In fact, he says it's the best long-term investment he's ever made. And here's why. With timber, you get biological appreciation. What is that? Biological appreciation, meaning biology is the reason that you turn $1 into $2 or $5 or $10, whereas there's no speculation going on here. Mother Nature's going to do that for you, regardless of markets and market timing. And the NCREIF Timberland Index shown from 1987 to 2014 that no asset class has beaten the returns on timber. No asset class has been able to perform consistently at around about 14% on an annualized basis. So here's the reason why biology is probably a safer bet than Wall Street. When you plant a sapling, you're not taking that sapling and hoping that sapling is going to be, the stock or the company that's that the rest of the world cottons onto, and all of a sudden everybody is buying and the shares are increasing value, that sapling's going to turn one day into lumber. And all throughout the world, for a multitude and millions of applications, people use lumber and will do and always have done. And so when you're putting pennies in the ground and you're turning pennies into hundreds of dollars, biology is primarily at play. In fact, over 60, almost 60% of the return on investment, the growth of the value of the money, comes from biology. Let me put it another way. In our programs, if you purchase into our private owner programs, one tree costs you approximately $50, give or take, to grow on the land that you own. So the purchasing of the land, the ownership of the land, the maintenance of the tree. But when it's sold, when it's harvested, it's worth almost $500. And it's not a long term. We're not talking 50 years. We are talking, 12, 15, 18 years. And some people are very, put off by that time frame. But, if you're an investor that understands liquidity is actually a poison, and illiquidity is a benefit, and we'll get into that in a second, you'll start realizing that, getting in and out of things is actually to my detriment, to my portfolio's detriment for me to keep doing that. It's better for me to have something that grows consistently at a nice number. That's how you create wealth. And if you're thinking about creating wealth, or you already have wealth, once you have it, you want to keep it. The term is actually illiquidity premium. The illiquidity premium is the extra return an investor receives as compensation for holding less than fully liquid assets or securities. Let me say that again. It's an extra return. It's an added bonus, a higher percentage of return that's received as a compensation for you for not getting in and out of things and buying and selling all the time. It's really something that most investors miss completely. A lot of people, have been putting the last 10, 12 years 10% and 15 and 20 and 25% allocations into precious metals, gold in particular, looking for portfolio insurance. I ask the question, really? I mean, precious metals is insurance for your portfolio? I don't think it's insurance. I think it's a bet. I think there's too many negatives to gold and silver for it to be portfolio insurance. First of all, there's no biological growth in precious metals whatsoever. So in other words, 1 ounce of gold, it's always going to be 1 ounce of gold. It's not going to grow one day to a gold bar. Of course, the value rises and falls. How's that insurance? Isn't insurance something that when you get a situation that you didn't want to have happen, but you bought insurance to protect against it, so when the bad thing happens and the negative thing happens, you actually get paid for that. The insurance pays off. So in other words, if you put $100,000, 10% of $1 million portfolio into gold, just to protect it and from insurance purposes, and gold goes down by 35%, no, there's no insurance play there. It's a loss. Then you've got to hold it and hope that it comes back. And gold and silver rises and falls, and a lot of us think it's even manipulated today. So it's more of a bet than it is insurance. And of course, you have no illiquidity premium because you can liquidate gold very quickly. Now, of course, there are some pluses. What about the other side of the illiquidity? You can get out quick. If you made a bad decision on something else and you need some cash, you can get out at the, just go down to the local vendor and sell your gold. If you've got gold coins, go to the gold coin shop. And of course, one of the good aspects of gold, which I am fully aware of and fully agree on, that it does protect your buying power. An ounce of gold 100 years ago could buy a nice suit. Today, it can buy a nice suit. So it does protect your purchasing power. But other than that, if you look at a chart of gold and compare a 25 or a 50-year or a 100-year chart against timber, gold is actually pretty lousy. A lot of people now are familiar with what's happening in the coconut world. It was kind of a commodity that's been around for forever, but the last 10, 15 years, as it's moved itself into hundreds, if not thousands, of new applications. from everything from biofuels to cosmetics and to activated carbon, and the list goes on and on and on. Here's a commodity that's across multiples and multiples of industries, uncorrelated industries. And of course, two companies have taken notice, Pepsi and Coca-Cola. They're probably the largest owners of coconut plantations in the world today. What's nice about coconuts, of course, it's a tree that spins off perpetual income. And it does so for 60 years or so after it started to produce nuts. So I know many people in the insurance world will talk about an annuity, and I don't know of an annuity that keeps on going after you have passed away. But if you own coconuts and you own the dirt, and the coconuts are being farmed for you by a professional, experienced management team, and those coconuts are sold into the marketplace on an annualized basis, and you start at age 50, those trees are going to be around when you're 110. And so it's a commodity that, like I said, the super wealthy are adding. Certainly, they're used to other farming and agricultural products. And so what our firm does is we grow money through timber, and we create income through coconuts. We're not a fund. We're not a REIT. We're not a partnership. We call it a pure play. You own the dirt. You want that underlying asset. You want the added value of the increase in value of the real estate. And then a company like ours will manage it for you. We're an experienced agricultural management firm. Some quick images of some saplings on the bottom right that we grew in 2015. They're all planted now. Almost 425,000 trees in the ground this season alone. And then on the left-hand side, the crews put in 130,000 coconut trees just in 2015. And of course, by the time our private owner program ends, we'll have put many millions of trees and coconuts in the ground. 25% of what we plant each season is available to private owners. Only 25%, 75% we keep corporately. And we take your product all the way from the sapling right the way through until the end use and off to the marketplace. So why agriculture now? Why is it an important topic? Well, it's because, as we started out, there's going to be a trigger. We don't know what it is. There's going to be another crash. We don't know when it will come. But when it does come, if you're an investor, are you going to have a crippling, gut-wrenching look at your statement and see that, well, it was $1 million, but now it's only 563,000? Or are you going to have a portfolio that, much like 2008 when the market fell 37%, timber rose 9.4%. So when some things are going down, there are some things going up. So think about what's ahead. Think about the messages and the information and the data that you've been researching. Think about when that next one will come, and what do you have in your portfolio that's a loss avoidance asset class? What's a shock absorber asset class? Is it real assets? Do you have any safety in the dirt? The super wealthy are moving as much as 20% of their portfolios into real hard assets, tangible assets, assets that do offer them the loss avoidance and their shock absorber qualities. Do you have any of those? Do you have anything in your portfolio? Do you have 10%, 20% in your portfolio that no matter what happens, they're going to be fine, and some of them, and maybe many of them, will even increase in value? If you're in your 50s, in your 40s, even in your 60s, and you'd like to supercharge your IRA, please give me a call directly. I can show you how, with timber, you can safely, in a self-directed IRA, turn an average IRA into a more than average IRA. Think long term, think generational. Make that extra return by holding less than fully liquid assets. Make that illiquidity premium. Call us and find out about our precious timber brochure to give you a little education on this. Join us on one of our upcoming timber and coconut discovery tours. talk to us about the tours. They're called discovery tours for a reason, so that you can come and discover the region, discover the country, discover the safety, discover the business people that are in Nicaragua now, and discover this space called agriculture. Our contact information is 855-888-6288. Once again, 855-888-6288. Or you can go to precioustimber.com, or you could email us direct at info@precioustimber.com. I thank you for sharing the time with me, and I hope I shed some light on maybe a topic that you were not that familiar with: loss avoidance and shock absorber asset classes. Make sure they're inside of your portfolio.